We are here for the last video for class 30 if you're in the Monday, Wednesday, Friday, so this is 30C. And Tuesday, Thursday, this is 21E. It's a short one, so don't freak out. You're almost there. 21E Tuesday, Thursday, people. Talking a little bit more about current liabilities, and now we're going to talk about liabilities that you have to estimate. All right? So, how are current liabilities that must be estimated estimated? What do? Well, how do we not know how much we owe? Right? Why would we ever have to estimate one? Well, a business may know that a liability exists, but not know the exact amount. The business cannot simply ignore the liability. It must estimate the amount of the liability and report it on the balance sheet. Common examples of liabilities that are often estimated are bonus plans, vacation pay, health and pension benefits, and warranties. So you can imagine you're going to come down to the end of the year and you owe people vacation, but you don't know how much they're going to take. You know that warranties, some people are going to return stuff that's broken, but you don't know exactly how much that's going to be, but certainly that's a liability, right? So let's talk about those estimated liabilities. Okay, bonuses. Many companies give bonuses to their employees in addition to their regular wages. These bonuses are often based on meeting a specific goal, such as the employee meeting an expected sales goal or the business achieving a targeted profit. Usually, a company does not know at the amount at the year end, so that you estimate the amount of bonuses based on a set percentage. For example, assume Smart Touch Learning estimates it will pay a 5% bonus on annual net income after deducting the bonus. Assume the company reports net income of $315 before the calculation. The accounting department will calculate the bonus as follows. Bonus times net income before bonus divided by 1 plus bonus 50 or 15,000. So this allows you to back into the bonus amount. Now I would always tell you bonus amount is 15,000. You won't have to calculate that. But obviously it's going to be an expense, so you'd go bonus expense and employee bonus payable. All right, so vacation, health, and pension benefits. Businesses typically offer vacation, health, and pension benefits to employees. A pension plan is a plan that provides benefits to retired employees. Vacation, health, and pension benefits must be estimated and recorded as a liability. Suppose Smart Touch Learning employees earn 2 weeks of vacation throughout the year. The company estimates that the cost of providing benefits is $1,000 per month. When an employee takes paid vacation, Smart Touch Learning will reduce the liability. Vacation benefits payable with a debit and credit cash. Other benefits, such as health and pension benefits, are recorded in the same manner. So here you go. You put the whole expense down. Vacation benefits expense, $1,000. Vacation benefits payable, $1,000. And then as people actually take the vacation, you debit, payable, credit, cash. Warranties. Many corporations guarantee their products against defect under warranty agreements. The time period of the warranty agreement varies. A warranty is an agreement that guarantees a company's product against defects. The matching principle requires businesses to record warranty expense in the same period that the company records the revenue. The expense, therefore, is incurred when the company makes the sale, not when the company pays the warranty claims. At the time of the sale, the company does not know the exact amount of warranty expense, but can estimate it. So this makes sense, right? You can imagine you're Dell, and you sell a bunch of computers every year, so you get your sales revenue. You know that some of those computers are going to get broken or not work quite right, and so they'll get returned under the warranty. So let's say they give a 1-year warranty. All right. So some of those computers, we don't know exactly how much, so we're just going to estimate it. So we're going to take this warranty expense at the time we sell everything, and then we'll assume that we have a warranty allowance, and we'll just set that up, and then as they actually do come in, we'll reduce the payable. Okay, so let's assume that Smart Touch Learning made sales on accounts of $50,000, costing $35,000, subject to warranties, and estimate warranties at 3% of sales. All right, so here's the assumption. We're making a sale. We're going to put our warranty expense on the books. All right, so here you go. So we make our sales. So we have accounts receivable and sales revenue. So that's just a regular straight up thing. We've learned how to do that. Then, because this is merchandise, we have cost of goods sold and merchandise inventory. Then we also put the warranty expense on the books. Warranty expense is an estimate. We decided 3%. So we sold $50,000. So 3% of $50,000 is $1,500. So we take warranty expense and estimated warranty payable. So that goes on the book. So now, later, people are going to return those computers and execute their warranty, like, hey, this isn't working right, here you, or whatever it is that this company sells. All right, so let's assume that some of Smart Touch Learning customers make claims that must be honored through the warranty. The warranty costs total $800 and are made on June 27th. The company replaces the defective goods and records a debit to estimated warranty payable for the $800 of warranty costs and a credit to merchandise inventory for $800. So what happens is, in this case, they replace the damaged or defective merchandise. So that means we got to take merchandise out and give it to those people because they said, hey, your warranty says I can get a new one because this one isn't working right. So $800 worth of stuff got brought back under warranty. So we take that warranty payable and reduce it, and then we take merchandise inventory and give them some merchandise inventory. Smart Touch's learning expense on the income statement is $1,500. The estimated amount, not the $800, actually honored. After honoring these warranties, the company's liability account has a credit balance of $700. This $700 balance represents warranty claims Smart Touch Learning expects to honor in the future based on its estimates. Therefore, that $700 difference is still a liability to Smart Touch Learning. So we're going to talk about contingent liabilities. So this is an interesting concept, contingent liabilities. A contingent liability is a potential liability that depends on some future event. A contingent liability is a potential rather than an actual liability because it depends on a future event. For a contingent liability to be paid, some event, the contingency, must happen in the future. How businesses record or don't record contingent liabilities is based on the likelihood of the event occurring in the future. Remote, reasonably possible, or probable. A contingency that is remote has little chance of the event occurring in the future. If a contingency is remote, the company does not record a liability and does not need to disclose it in the notes on the financial statements. Contingencies that are reasonably possible have a greater chance of occurring but are not likely. A reasonably possible contingency should be described in the notes to the financial statements. If a contingency is probable, it means that the future event is likely to occur. Only contingencies that are probable and can be estimated are recorded as a liability and have an expense accrue. So we tend to think of contingent liabilities as something that may or may not happen. And if it's remote, we don't care. Don't put it on the books, right? If it is possible, if some people need to know about, put it in the notes. But if it's definite, put it down as a liability on the books and have an expense accrue. A good example of this would be a lawsuit. So imagine you're the accountant for Walmart, right? So somebody is suing you, and you have to figure out, well, are they going to win that lawsuit? Is it very likely? And if they do win it, how much? Right? So that's a contingent liability. So if it's very remote, you don't worry about it. If it seems like they're probably going to win the lawsuit, but you're not real sure how much, and you're not 100% sure they're going to win the lawsuit, you put it in the notes. You say, hey, somebody's suing us. Here's what the suit's about. We don't know. But let's suppose they're suing you, and your lawyer says, yeah, you guys are going to lose. And you're going to have to pay them $1 million because your floor was slippery and they fell and they broke their leg. So that's going to happen. You're going to lose the lawsuit. So that's the kind of liability that, no, you haven't lost a lawsuit yet, but you know what? You're definitely going to. You know you're going to. You know you're probably going to settle it and pay them $1 million. So put that on. Contingent liability, that just becomes a liability. Goes on the books. Because you know, right? Even though it hasn't really happened, you're pretty sure it's gonna. All right. So here's this table, 11-4. It summarizes the rules. Remote, don't disclose. Reasonably possible or probable but can't estimate, put it in the notes. Probable and can estimate, it's a liability. Okay, let's talk about times interest earned ratio. All right, so you're thinking about investing in a company. Are they any good? What kind of ratios can you look at? Well, we've talked about several. Today we're going to talk about times interest earned. Investors can use the times interest earned ratio to evaluate a business's ability to pay interest expense. This ratio measures the number of times earnings before interest and taxes, EBIT, can cover or pay interest expense. The times interest earned ratio is also called the interest coverage ratio. Makes sense. A high interest coverage ratio indicates business ease in paying interest expense. A low ratio suggests difficulty. The times interest earned ratio is calculated as EBIT, net income plus income tax expense plus interest expense divided by interest expense. So, another great ratio. We're going to talk about all the ratios together in one big chapter coming up soon. So, that's it before your next exam. So study. Remember, I'm going to give you those amounts like FICA, SUTA, FUTA, even your interest calculations on this exam. So good luck with all your studies, and we'll see you in class.